The traditional banking model is breaking. Across the industry, the standard value chain is undergoing a structural disintermediation. Historically, banks operated as a single closed-loop system. A single entity managed every layer of the process, from product manufacturing and back-end operations to customer distribution. That model is now fracturing. The manufacturing of financial products is permanently decoupling from their distribution. This split is driven by open banking mandates and the adoption of Open Application Programming Interfaces, or APIs. An API is a set of rules that allows different software applications to communicate and exchange data with each other. Open banking represents a systemic re-architecture of financial services. This shift was initially triggered by top-down regulatory mandates in major global markets. Europe pioneered this with the Second Payment Services Directive, or PSD2. This legally required banks to provide external third parties access to customer account data. Australia expanded this concept with the Consumer Data Right, or CDR. This mandate pushes beyond banking, creating a broader open data economy across multiple industries. Contrast this with the US and Asia, where technology and e-commerce giants are driving a similar unbundling of the value chain through market forces rather than regulation. Regardless of the driver, the result is a standardized, two-sided API economy where financial data is no longer held in silos. This new ecosystem relies on two specific operational roles. On the left is the ASPSP, or Account Servicing Payment Service Provider. ASPSPs are the institutions, typically banks, that hold customer accounts and manage the primary financial ledger. The ASPSP acts as the core data provider, maintaining the underlying financial records and the authority to move funds. On the right is the TPP, the third-party provider. TPPs are regulated fintechs or service providers that use the bank's data and payment access to create new services for the end user. The TPP acts as the data consumer, building innovative software layers on top of the existing banking infrastructure. The API connection bridging these two nodes is the mechanism that replaces the traditional monolithic bank. Understanding this two-sided relationship between the provider and the consumer is the prerequisite for grasping the mechanics of banking as a service. TPPs operate through two distinct functions, each requiring a different API pathway. First is the AISP. AISPs securely retrieve and consolidate account information from multiple institutions, creating a one-way, read-only data flow. Consider an accounting platform pulling transaction data into a dashboard. It reads data but cannot move funds. The second is the PISP. PISPs initiate payments directly from a user's account with their consent, creating a two-way, write-access flow. An example of this is a merchant platform that allows a customer to pay by bank at checkout. In this scenario, the PISP instructs the bank to move the money directly, entirely bypassing the traditional card networks. These two pathways involve different levels of risk, as one merely retrieves information, while the other executes financial movements. Combined, these API pathways form the functional foundation for modern embedded finance. Opening up ledger data creates a critical security requirement. How does the bank share sensitive information without compromising the system? The entire system operates on a rigorous, consent-driven protocol, governing every single request for data from the underlying ledger. When a user grants explicit permission through a TPP, the application issues a secure digital token. This triggers strong customer authentication, using at least two independent factors like a password and a biometric scan. The bank verifies the token cryptographically and only then opens the specific API endpoint required to share data. This tokenized mechanism reduces the risk of fraud and the need for less secure methods like document sharing or screen scraping. Ultimately, the user's consent token, not bank policy, acts as the gatekeeper for open banking. We can see the real-world impact of this architecture in the field of credit scoring. Globally, 1.7 billion adults are unbanked. In the US alone, 22 million people have a thin file, meaning they lack the credit history required to access loans. Traditional credit bureaus rely on static demographic proxies and historical debt, often rejecting applicants without history. Open banking offers an alternative. An AISP lender queries the applicant's bank directly, analyzing real-time behavioral data, like consistent salary and rent payments, to accurately assess creditworthiness. This shifts the decision-making process from historical snapshots to real-time cash flow analytics. This approach allows lenders to increase loan volumes while reducing the risk of default. Open banking transforms creditworthiness into a dynamic behavioral analysis rather than a static historical record. Zooming out, we can see how these API pathways have restructured the entire banking landscape. Banks are adopting three strategic models. In the distributor model, a bank acts as a TPP, selling third-party products. As a manufacturer, the bank acts as an ASPSP, providing core back-end services. In the platform model, the bank orchestrates a web of integrations. Executing these strategies requires a deep understanding of the technical roles defined by the ASPSP and TPP framework. The stakes are high. Estimates suggest that digital disruptors could erode up to 50% of traditional banking volumes in areas like payments and investments. Hoarding proprietary data is no longer a sustainable strategy in a disintermediated market. Banking as a service and embedded finance now provide the essential modular infrastructure required to build the next generation of digital-first financial products. Traditional institutions failing to adapt to this API economy risk being outpaced by more agile competitors. Every financial institution must now decide where it fits into this unbundled value chain. The future of the industry belongs to those who control the API ecosystem.